again, thanks for being here this Saturday. I love these Saturday events, where markets are closed, you don't have to be distracted. So we're going to get down into it today, talking about what I call the option strategy guide that I use. So really kind of identifies when and how to use certain option strategies for the best results. So let's get started. So a little background on myself. I've been actively trading in the markets since the 80s, back 40 years ago. Wow, pinch myself thinking of that. But started on the oil side, cargo trading, products, things like that. Went on to a company called Trans World Oil, which at that time was the largest oil trading company in the world. It was Trans World, Fibra, Mark Rich. And so spent about 17 years there. Ran the international trading desk out of Bermuda for Trans World for 10 years. And so that's where I basically got my start on the option side. So it's about 1987. Started trading options. We started trading options on cargoes of crude, and it was just such an exciting experience that really kind of piqued my interest. So at that time, we were just kind of selling premium, bringing in premium. But the more I got involved with the different option strategies, just the lights really started to come on. So that's what we'll talk about here today, kind of some of the great option strategies and when and how to use them, and how to identify these specific types of strategies. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So the secret to trading profits, in my opinion, really comes down to using options for your risk management, leverage, so many different advantages that you'll receive from them. So when you look at trading, trading is a business of probabilities, and to be a successful trader or investor, controlling risk is what's going to really win the game for you in the long run. So knowing and better understanding how to manage and control your risk is going to make a dramatic and positive difference in your trading or your investing performance. And one of the best ways to achieve this kind of goal is through the use of options. So these options, different strategies can be used for day trading. You can actually day trade with options. You can swing trade, which are kind of longer, intermediate type trades, or you can go long-term investing using different option spreads. So there's no really better way to trade or invest for unmatched greater returns with much less risk than through the use of option spreads. Now, trading options have so many more advantages than trading stocks, but they can be confusing and debilitating to traders or investors unless you know which option strategy to use and when and then how to use it correctly based on the market environment you're trading. So I call this debilitating trading dysfunction the option strategy confusion, or OSC. So many of us have had it. So many of you probably have it right now. So I'm trying to clarify what you can do to solve this OSC. Now, the option strategy guide is what you're going to need to learn, and that's what we're going to talk about here today. So it's what you'll need to know to successfully trade options. So we're going to get out of that no more OSC option strategy confusion and clarify things a little bit more for you today. Now, the first step, though, is you need to understand how option pricing works. So this is going to help you to maximize your option trading profits once you realize the understanding components that make an option price, kind of work. So when we're pricing an option or trading options, the most important option factors to understand is coming down to understand the concept of time and volatility and how they impact the price of an option. So, what exactly is time value? Now, time value, or the extrinsic value of your option, is a premium, or the premium that a rational investor would pay over its current exercise value, the intrinsic value based on its potential to increase in value before expiring. So the change in the value of an option based on this time decay can be measured using the Greek called theta. Now, time decay always works against buyers, but it's going to benefit the seller of an option. So why is this? Well, when we look at option theta, they're going to have values of either a positive or a negative value. So all long stock options, so let's say you're long a call or a put, those positions are going to have actually a negative theta value. So it's going to indicate that if the stock moves sideways and doesn't go the direction that you need it to, you're going to lose value on that option each and every day as expiration draws near. So that's a negative theta value to your position. Now, the opposite side of that is all stocks that are short. So if we're short a stock option, a call or a put, that's going to give us positive theta value. So if the market churns sideways and doesn't, go straight in the direction you need it to, that your position is actually gaining value as expiration draws near. So that's giving you that positive theta value effect. Now, many option trading strategies are going to sell out of the money options on top of buying either at the money or in the money options. And this is done in order to offset that negative theta, and also is going to result in lowering your rate of time decay and also lowering your rate or capital at risk. So that's the beauty of spreads. We can really make a big effect on positions by, lowering that negative theta, giving us positive theta, and lowering our capital at risk. So the spreads that kind of do this, where you'll be long and then sell something against it, are going to be what we call the vertical bull call debit spread, the vertical bear put debit spread, the butterfly spread, and the long condor spread. So these are some that are generally where you might sell something against it to kind of lower that theta and also lower your at risk. Now, when we look at the volatility price component, this is boiled down to implied volatility. And implied volatility is expressed as a percentage of the stock price. So it's indicating a 1 standard deviation move over the duration of your option cycle or series. So I look at 1 standard deviation as kind of a normal potential range of price, okay? So in theory, a stock should end up within 1 standard deviation of its original price 68.2% of the time during its option cycle. So this theoretical probability or forecast of a securities price range should be part of your process that you use for selecting the highest probability price targets for any of your trades taken. Now, when we look at the value of an option, it really comes down to these components: time value times the implied volatility times the underlying security value. And once you know these variables, then you're going to be ready to price out that option, know what its option premium should be, and then select the best trade for the environment you're trading in. Now, when we look at the pricing component, this is kind of will help you to kind of flow through how these components work to create price. So here's your time value times the implied volatility times the underlying security value. So we're going to keep this at a constant of 1, so you can see how these time and volatility affect price. So on weekly options, every Thursday we have a new weekly option series. And so I like to use weeklies for pretty much all of my trading, which are swing trades primarily, which could be a trade that could last a day up to 2 weeks, something like that. So when we look at the value that first day, we've got 100% time, all right? Now the implied volatility just plugged in a number here of 300, so 1 times 300, and kept the underlying value constant. So you get an option price or premium of $300. Now you can see real quick that on Monday, once you come in, after the weekend, that time value component's cut in half, right? So that's going to affect price. So even if the implied volatility, let's say we spiked it to 800, the time value component's cut in half. So your price would only be $400. Or let's say your implied volatility was 200, so your price would only be $100. So you can see the big takeaway here is that at the end of the day, when we get into the expiration of this weekly cycle, time is going to go to 0 and the implied volatility go to 0. So that's the great thing. We can take advantage of this decaying time and also what we call volatility crush to capitalize on the benefits that it gives you for your option strategies for certain spreads. And we'll talk about those here in just a bit. So that's kind of a price, kind of run down a summary how option pricing works. Now, the other thing is pretty cool is how you can trade time. So what is that? We can actually trade time by selling time. And we do this to take advantage of that option time decay component. So by selling time, we are in essence selling time, and we're selling volatility when we're selling an option. So think about an option like a coupon that you get at a store. So you look at the redemption value or date, and you have to use that coupon by such a date, or else it's going to expire, worthless. And that's exactly how an option is, kind of like a coupon. So you need to realize there's a certain fixed time to the trade, and that's what we want to take advantage of from time decay. Now, when we look at a time graph here, you can kind of see it more vividly. So here is a time decay from going out 120 to 90 days out. So when you're this far out, further out you go, you start out with very little theta decay or time decay. Now, as you get closer in and start approaching expiration or day zero, you really get that accelerated theta decay about 30 days out. So that's where it really starts accelerating. Then we've got the weeklies, and those are kind of really turbo time decay. So you can really get that fast time decay going. So that's what we can take advantage of. Now, the gift of time is if you're a buyer of options. So the further out in time you get, the less theta decay. But if you're selling options or spreads, we can take advantage of this, really big sell-off or time decay and volatility kind of crush. So that's the beauty of the spreads. We can mix and match, combine buying options with selling options. So when we look at the next step, it's really understanding the probabilities. So again, trading is just a business of probabilities, and options really are a business of probabilities. And it's what I call the market maker's secret. It's what they don't want you to know. Now, the option markets use mathematical market probability statistics for pricing out the movement of an option to its expiration. So by knowing then the probability of an underlying security finishing within a certain range at its expiration becomes key to determining, okay, what options you're going to buy or sell and what option strategy should you use. Now, these statistics, we're going to forecast how likely it is that an option will fall within a certain option series price range up or down by that expiration date. And this forecast is what we refer to as the implied move or the implied expected move of your stock or security. And again, the implied move is kind of an estimate of a plus or minus 1 standard deviation move over the underlying security's lifetime. And again, I'll look at standard deviation as kind of that's the norm, okay? That would be the normal range of price or whatever you're measuring by standard deviation. Now, when we look at, the option, we look at this distribution curve, you can kind of see it better. So if you look at this bell curve here, so this is going to give you kind of what we look at standard deviation. So this is the at the money, so XYZ is traded at $500. Now, if you're selling an out of the money option, you sell it 1 standard deviation out of the money, you're going to start this trade out theoretically with 84% theoretical chance of winning. All right, that's because the delta of your option. So just a quick kind of summary here. The delta kind of refers to, I use it for probabilities of price hitting a certain point. So if you look here at the 1 standard deviation point right here, this would be, in this example, is 520 and 480. So these 2 points are going to roughly have a 16 delta or 15.9, which says that there's a 15.9 or 16% probability that price could get there to 520 or it could get to 480. So if you take that 16 delta, and a delta of 1 is equivalent to 100 shares. So remember, if you buy an option contract or sell an option contract, it's equivalent to 100 shares. So a delta of 100 less 16 is 84. So that gives you an 84% probability. The way to look at it is that price will probably, 84% probability of price being below 520 by expiration, or the other way around, if you do the put, 480 being above 480. All right, so that's that price point of the delta, the percentage probability, and if you did a delta of 5, that's a 95% chance of winning. So that's kind of where we start out to get a kind of idea of the probabilities or forecast of price that we're going to need in order to set up a trade. Now, here's another good example. So this is the option chain on Apple. So Apple here is trading $190 basically, 28 days to expiration. And the probability, this is some information we get. This is the implied volatility probability out of the money option delta. So one thing that delta does is tells you how much your underlying security, option price goes up based on, the delta a dollar plus or minus times that delta. So that's one way. But the way I like to look at it, and the way we're looking at it right now, is using delta for probability. So if you see this $190 strike here, and Apple trade at 190, you'll see that the delta here is 52. So one way to interpret that is you've got a 50% chance that price will be at 190 or below, or 190 and above. And you see this probability out of the money, it says 50.86. Now, if you roll out to the 202.5 strike, you can see that the option delta is 20. All right, so one way to look at that is that there's a 20% probability that price can go to 202.50 by expiration within the next 28 days. Or the other side of that, the probability that it'll be out of the money is the reciprocal of that. So you can see it's 82.22. So there's 82% probability that price will be below 202. Now, if you go way out here, the 215 strike, you can see the delta is 5. So that could be interpreted as 5% probability that you can get to 215, or reciprocal 95, 96% probability that price will be below. So you can see that's why option prices look really cheap when you go further and further out. So you can see this 215 strike, the bid ask was like $26, $27. So these are cheap, right? And it's cheap because that's high risk. There's a very low probability that price will get to 215. So if you're buying those options, you know, you're taking a lot of risk, but if you get it right, you've got a big, huge payoff, right? So that's kind of one way to really look at the option delta for the probabilities of where price can go. Now, so by using this kind of probability analysis, it's going to really help to provide you a useful tool to determine your price targets to trade against. And it's also very useful for setting your hedges. All right, so based on the math of probability, you can see that approximately 70% of your options bought are going to expire worthless. So based on this, it's always a good idea for all traders and investors to not only consider selling options, but also, you know, look at the buy side, but also looking to sell options. So when we combine the two together, that's what really makes kind of option trading pretty exciting. We combine the two together by buying and selling option. It really creates unmatched option trading strategies that you can use to provide greater returns with a lot lower capital at risk. And that's always a win-win situation for traders or investors. So the next step is, you know, selecting the perfect option strategy. So we want to do that based on a couple of different conditions within kind of this formula that I look at, or the process. So we want to look at, okay, what's going on in the market? We want to identify the market cycle. So this is very important. So the first thing, do you think the market's going up in a cycle, down, sideways, or you have no idea? So you first need to identify a market cycle. And there are a lot of different ways we can do that. The second step in the process that I use is to identify specific chart patterns. So there are 5 select high winning probability chart patterns that I look for to identify, and those can tell me then, okay, what kind of option strategy to use based on the pattern. Now, the third step to the process is your time horizon, or the trade duration. When do you expect the trade to make money? So do you think it's going to be a day trade? It could be today, tomorrow, next week, or next month. So you want to have kind of an idea of your trade duration. And that's where we can use the implied expected move to give us a better idea of that trade duration and which option cycle to use. Now the next one is capital at risk. So based on the market conditions you're in, if you're in low risk, medium, high risk, you want to kind of look and measure the extremes of the market. So based on the extreme of the market, that can also tell you then, okay, what strategy should I use? If I'm in a high risk environment, which strategy would be best to use versus kind of lower risk? And then the next one is your objective. Are you looking, more for income, say passive income, profits, just, outright trading for profits? You want to hedge more and you want to take advantage of, longer term trades for capital gains. That's going to be, something to consider in the process of what option strategies to use as well. Now let's take a look at the different strategies and when to use them. So the basic ones that I like to usually go to will be either a long call or puts, okay, buying calls or puts. The other one is the vertical debit spread, a vertical credit spread, the butterfly, long condor, income calendar, calendar diagonal. So these are kind of the main strategies that I'm always going to look at and dip into based on what the markets are doing, the conditions, and this process here, okay? So those are the primary strategies to go to. Now, when we look at calls or puts, these can be great for your day trades or swing trades. So those are trades that can last a day to 10 days or a little bit longer, or they can be used for longer term trend trades. Now, generally, when you use go long calls or puts, it's easier to just identify it by go long either a 50 delta, or you might want to go in the money a little bit to a 70 delta strike. So it's going to give you a defined risk, but if you're long calls, it's going to have unlimited potential profit. If you're long puts, pretty much unlimited, you know, all the way to the downside of zero. Now, the next combination would be the vertical debit spread. So this can be used for your swing trades or longer term trend trades. So this is going to be a defined low capital cost type trade, low time decay, because it's got an additional component to it. It's not only just buying calls or puts, but you're going to be selling a call or put against it. So it's going to give you profit, but your upside is capped, but your risk is capped. It's going to lower your capital at risk. Now, the other side of your credit spread is your credit spread. So you've got the vertical debit spread. So this is the debit cost. And then you've got the vertical credit spread. So the credit spreads can be used for day trades or swing trades. Going to be best used when your implied volatility is higher because you're going to get more premium from selling an option. These are defined risk as well. Takes advantage of the time decay and sideways price action. Profit is also capped to your credit received. So those are the spreads. So you need to understand the concept of your vertical debit spread and your vertical credit spread. And then when you combine the two together, you can do all kinds of different other option strategies. So when we look at the vertical call debit spread, you can see it's got what we call a positive risk ratio. So in this example, you'd be long, say, a call here, and that's about the 1,010 would be your call strike. And then you sell a call here at that 1,020. So you can see that's a $10 wide spread, okay? So it's $10 wide spread, and here your total debit cost is 300. So that's your max at risk based on the debit that you're putting out. So the difference is if you take 1,000 less that 300, you've got a potential max profit of $700 if it closes above that 1020 at expiration. So that would be like a 233% return on your capital risk of 300. Or you can look at it as you're risking $1 to make $2.33. So that's a positive risk ratio. So that's why combining spreads really is the way to go. So the other side of the coin is your vertical credit spread. So in this example, same spread width, okay? So here, but short a call here at 1020, and then $10 wide, long call here. So it's a capped risk trade. So $10 wide spread, so $1,000. You bring in a credit of 200, that's your profit, that's your max profit, $200. So the risk is your difference, potentially $800. So this is what we call a negative risk to reward ratio. So you're risking $4 just to make $1. Now the reason this is lower is because these are what we call probability trades. And again, if you back up and think about one standard deviation, if you're selling that one standard deviation point, you're basically going into the trade with a theoretical 84% probability that price will be below your short strike. So that's the way to look at it. And that's why you've got this negative risk reward ratio. And your only profit would be the credit you receive. So that's the big difference. But when we combine these two together, that's what's exciting. So we can combine these kind of mix and match, and we can create things like a butterfly spread. So this option strategy combines both buying and selling options, the vertical debit spread with the vertical credit spread. So it's going to give you a defined risk trade, takes advantage of time decay and implied volatility, provides positive theta, no time decay, Great for directional trades, or you can even use non-directional kind of swing trades, trades for a day to 2 weeks out. When correctly used, it's going to provide you the highest return on capital at risk of any other option spread strategy. So the butterfly, based on its combination of buying and selling, will give you an unmatched return on capital based on this specific strategy, and it's great for hedging. Now, here's the basic look of a balanced call butterfly or put butterfly, doesn't matter. So here you're long a call, or it could be a put, short a call here, short another call, and then long call. So we can do it with calls or puts. All right, so we've taken this trade. This was kind of originally that call debit spread, the $10 wide, and then we sold a bear call credit spread, and now we created this butterfly, and the risk is $100. So theoretically, though, if it was to go out right there, that would be a $900 profit on your risk of 100. So it's a huge potential return on capital. And also you're defining your risk and lowering your risk when you do this. And also you'll have no theta decay when you do a butterfly. It's a positive theta trade. Now the other one is kind of what I call the cousin to the butterfly. It's called the long condor. So like a butterfly, it's a combination of both buying and selling options, the vertical debit spread with the credit spread, but it's not going to share the same short strike of the vertical debit spread. So what it's going to do, it moves that vertical credit spread short strike further out of the money. So this is going to give you a bigger profit zone, okay, wider profit zone. So it's going to provide you also a positive theta, no time decay, great for swing trades 1 week to maybe 2 weeks out, very high return on capital at risk, also great for hedging. So the difference is basically, instead of the butterfly, we're going to spread out the spread a little bit more. So here would be your butterfly kind of sharing that same short strike. But this one, we're not going to have the same short strike. We're going to spread it out some to give us a bigger profit zone. All right. So that's just basically a debit spread with a credit spread, but we're spreading it out more to give us a bigger zone of profit. But it's going to give you also great return, lower capital at risk, and a positive theta trade. So the next one that I really like to go to are what we call the income calendar spread. So it's a kind of a favorite medium to longer term non-directional strategy. So the income calendar is a neutral option strategy that's going to profit from your underlying stock remaining stagnant or trading within a tight range. So the profit comes from the difference in the rate of premium decay and the applied volatility kind of crush between the near-term short option and the long-term longer dated option. Okay, so remember, this is going to be possible because the near-term option premiums decay faster than the long-term option premium. So that's the beauty of this kind of a neutral strategy, is just taking advantage of that time decay and also implied volatility. So you're going to use this spread when expecting the stock or security to stay, again, stagnant within a tighter range, and it's going to produce income from the time decay component of the spread. So it's also great for market conditions when you want to keep a long-term position intact for a particular stock or ETF, when you're expecting it to potentially break out a little bit later to either the upside or downside in the future. So what this strategy does, it allows you to be positioned to get paid while you're waiting on that long-term trend to kick in. So this is one that we a lot of times will put together for a longer-term trend trade, and then we can easily adjust it to what we call the calendar diagonal, which is the next one we'll talk about. So basically this sometimes is called a timing spread or horizontal spread. So all it's doing in theory is you're using the same strike. So in this situation, you'd be, let's say you go out and you sell 30 days out, or we can use weekly options. You sell the $100 strike, okay? You're short that 30 days out, or it could be a weekly option, so 1 week out or something. But then on top of that, you're long that same strike, the 100 strike, but 60 days out. So what you're playing is just if it didn't do anything, the short strike here is going to get that positive theta decay, right? It's going to get that theta going in your favor. And this one could just sit there and stay right at 100, but this one is going to decay. You're playing that spread decay between, the short duration, you're sold the 100 strike, and you're buying back here at the 100. So that's kind of just the overall concept of how it works. Now, the next one is just kind of a kind of derivative of this is your calendar diagonal spread. So again, a very favorite kind of medium to longer term directional trade strategy. And again, it's basically a vertical diagonal debit spread where the long option leg expiration is going to be set further out in time versus your short option leg, which is going to be set closer in time. So again, it's going to take advantage of your short-term weakness or strength that you think will eventually in time revert and cycle either back up if you're using call-based kind of diagonal or down if put. So this really helps to provide time to let direction kick in. So a lot of times we'll maybe start with a calendar spread to be really cheap, low risk. And then if it's going in our direction, we can adjust it to what we call this calendar diagonal. And we can do it for trades that are going up or down, so we can use calls or puts. So we've got a combination of things there. So the construction of the calendar diagonal takes advantage again of that accelerated time decay characteristic of that front short dated option that's going to decay faster at a faster rate than that back long dated option. Plus, if you've got what we call horizontal skew, the implied volatility difference between the two is also a big kind of advantage. So there's that additional vertical spread component that adds to the directional component for greater profitability. So you're basically buying options at a discount. So it's sometimes referred to as a poor man's covered call. So instead of though buying the underlying security shares, you're going to be long, the underlying option contract. So it's going to be much cheaper and less risk than doing covered calls. So this one, for example, would be, think about if you did a vertical debit spread, okay, it would be in the same option series. So let's say the 28 October, okay? So 28 October option series would be just a vertical spread, if I can draw this, okay? So this could be like your long and call it here, the 100 strike, and then you're short the 105 call here. So that would be in the same option series, that would be just a vertical debit spread. So the calendar diagonal though, what it does, instead of buying the same series, this would be going out further and you'd be, let's say, buying the series out, maybe the 18 November would be your long dated, so further out, okay? And then you can be short that, I'm sorry, got this backwards. So let me start over here. So what you're doing is you're selling the long dated. So what you're doing here is you're doing a call. Let's say you did a call or put. So here would be, you go out and buy further out a call, say maybe the 18 November series, okay? So you're gonna have less theta decay on that one. And then you're gonna sell against it, the call here, which might be the 28 October. So you're gonna have that much more accelerated theta decay. Plus you've got the diagonal component of the spread. So it creates a really dynamic structure for big profits, that you could amortize down like a covered call over and over and over to where you could actually whittle and amortize it down to zero cost on your long dated side of the trade. So let's take a look at some different examples from different trades that we've done, in these different kind of categories. So these are all alert trades from my alert service. So these were trades that were sent out to our members of the alert service. So let's take a look at a vertical debit spread. We're going to look at the butterfly spread, long condor, income calendar, and the calendar diagonal. So these are kind of the ones that I like to go to for the different market environment you're trading, different whatever chart pattern, trade duration, all the different things that go into selecting the right option strategy. So first off, we did this a QQQ short trade that we did. Again, these are alert trades sent out to my alert service members. So this was a put debit spread, okay? Just a basic put debit spread that was set up on the 11th of May And QQQ was traded at 298.30. Okay, and so then we took it off just 1 day, 2 days later. It's just very short duration, right? So it's this was like a day trade basically. So you can see, I won't go through the detail too much, but here was the alert that was sent out on the 11th. It says new QQQ short trade at 298.30, market oversold. So be careful on the shorts. This is a short-term day trade, may hold longer depending on today's price action. So basically kind of a day trade. So you're short this trade. So we're buying the 13 May 298 and selling the 290 same series, okay, at around 295. So could convert it to a butterfly or condor if we wanted to. And then the same day, we started taking profit because this thing moved down so hard, which we were looking at it to do. And we were able to get in and out of the trade within 1 to 2 days on this trade setup. So here's what it looks like when you look at the chart here. This is based on our trading model that I use for all the trades taken. And so it was right here. You can see on the 11th, so which short, I used our momentum indicators to kind of give us a guide as to direction. So they're negative. And so we moved down, and then I used Fibonacci for, and moving averages for, pricing out targets. Okay, so here went short, and then that was on the 11th. This is a 4-hour chart, so you can see the fast movement down, and then took profit here, also the first day and also the second day right there. So this one had a great move, really quick move down, and was able to take a great profit with lowered theta decay and lowered capital at risk. So you can see the max profile of this trade would be, it could be, it's a $8 wide spread. The maximum profit's 520. The at risk is your debit paid 280. So it's a $2.80 debit to buy the 298 put, sell the 290, $8 wide spread. Total at risk 280, max profit 520 if you got it perfect. And that would be like a 186% return. Now we set the trade up here, and this trade ended up making $346 per spread. So let's take a look. Still really great return, and this was done in 1 day. Okay, so kind of a situation for a quick in and out trade, very low at risk trade with the debit. All right, so here's what the trade looked like on the risk profile going out. You had trading right here when it was taken out, so the 12th, and it went from 298.30 when it was set up to 286.48 here on the 12th. So this was up, went from 280 to 626 was a spread. So that's a profit of $346 per spread right here, or 124% return on your capital at risk, and that was basically 1 day. So that situation was kind of more of a day trade. We want short duration, but we want to keep our risk capped. So we did a put debit spread versus just buy outright puts. Now the next one we'll look at is your butterfly. So these are what we call the wide wing butterfly. So with the wide wing butterfly, we're going to give us a bigger profit zone to work with. So the wider the butterfly, the bigger the profit zone, the easier it is to make profit. So again, I kind of relate that to if you're trying to catch a butterfly, it's going to be easier for a big butterfly net versus a small one. So this is where we can adjust the width of your spread, for profit, loss, or risk. So we do that with that butterfly spread width. So again, it's going to be defined risk trades, great for hedging, great for what we call targeted directional swing trades, great for what we call pinning trades, where it goes out a specific strike. Great for trading high volatility market, great for trading high price stocks, because we can do these trades for very little at risk, very little cost, versus if you're just going long calls or puts. Trade duration, it could be 1 day up to 2 weeks is typically the kind of the time frames that we'll look at. Always going to give you positive theta, so no time decay. Returns, again, of all the different spreads, this will give you the highest potential return on your risk of any option strategy. So 2 to 1, 10 to 1, or even higher. So let's take a look at a couple examples here. So this was a short trade on SPY, all right, using a wide wing butterfly that was $7 wide or $700 per spread. So this, again, alert trade setup sent out to our members. And so you can see new SPY short trading around 378.91, market below prior day's low by butterfly, the 26th September, 377, 370, 363. Okay, so that was the spread. Now look at the cost. The trade risk was $115. That's your max risk, is the debit paid. Now you can reduce that. You know, you can always get out before, you know, it hits your 115 as your max loss. So potential profit though on expiration in this trade setup would be $585 or 508% return. So basically you're risking $1 to theoretically make over $5. So that's what makes it such a great trade strategy for really high extreme market volatility, because of the, you know, markets could swing back and forth really fast. So you can keep your risk super low. So here's the trade setup here, the charts. Again, using momentum for direction. So we've got a short was set up here on the 21st, momentum negative. So we went with the short trade here. And at that point, it was traded at 378. So shorted it there and then got out a few days later on the 26th. It was trading out 369. So went down perfectly and we were able to get out here. Yeah, 115. Yeah, so get out there. Let me back up a second. I should have been 115 at risk. Yes, well, when this was sent out, I put it in the alert at around 110. When it was actually executed, it was 115. Okay, so this is kind of give or take. So when these go out, you know, the markets are moving, so it can change. So this was when it was sent out, it said 110, said around, but actually set it up, it ended up being 115. Okay, so shorted there and covered here when it was down to 369, and did this with the butterfly. So again, targeted the trade. And so the trade, we were targeting that 370 strike right there. This was based on Fibonacci and moving average kind of support resistance. So you can see 377, 370, 363. Now, think about it. If you had just done the ETF and shorted the shares of SPY and it hit your target 370, well, you would have made $8.91 per share. Your return on your capital at risk, though, would have been in this situation 2.35%. But with this trade, doing the butterfly, your risk was only $115. Okay, not the share. You know, if you did the share, it's going to be much greater, and your potential profit in risk reward is going to go, so 700 minus your 115, so theoretical 585. So you could theoretically make 508% return on this versus here, you would have only made 2.35% return. All right, so that's the beauty of just spreads in general, but especially this butterfly kind of combination. So here it was where it went out, wasn't max profit, all that black area is still potential profit, but took the trade off here on the 26th. It was trading out at 369.79, so it was trading right there. So this spread went from 115, now it was out to 355, which was a profit of 240 per spread on your risk of 115. That's a 208% return in 5 days. So you can see there's no comparison as far as risk reward, returns, things like that. So that's just the basics there of a nice wide body butterfly. Now, this was expiration the 26th, and it was just trading right there earlier in the day. At the end of the day, if you'd held it, it was right here, this thing was going to be up to the max profit, because all that black area is still what's component of time and volatility that's still left in the spread. So that's a wide wing butterfly there. Now here's another one. It's been hard to short Apple, right? But Apple looked like it was breaking down. So we shorted Apple with a low risk wide wing butterfly. So in this one, it was a $5 wide or 500 spread width. So shorted Apple, looking at it to to drop down, but we're nervous about the, Apple's hard and short. So this one was put on for total risk $74 per spread. So it's fantastic. So we set this trade up on the 29th of September. So new short trading at 145.62. Daily close below 147 opens the door for potential move lower to 140. Buy the Apple 7 October 145, 140, 135 at around 70 cents. So set this up, it ended up costing 74, and that's our max risk. Now, here's the trade setup. When you look at the charts here, momentum -1 and 2, so down we go. And then it was a butterfly, so it just starts churning. It was right there at our target going out at expiration. That's the perfect kind of scenario. So set this trade up, it was trading 145.62, and then on the 7th, it was trading towards our target of that 140. So we had set this up as a balanced put butterfly, targeting 140. Again, if you just did the ETF short, you would have made $5.62 or 3.85% return on your capital at risk. So this one was buying the 145, selling the 140, then selling that 135. So we had that balanced butterfly here. But the big thing is, look at the risk, $74. That's the max that you could lose on this trade. Spread with 500 minus 74. So theoretically, you can make 426 or 577% return. So really a sweet kind of setup. Yeah, so when the trade was set out, it was set out around $1.10 because the market's moving. I send these things out with what we call Telegram, which is a really fast alerts that I send up that I use. So again, just, said at around $70, okay? And this ended up being, let's see here. Okay, so that's the risk there, 74. Now it ended up going out on the 7th. It was traded at 140.29, so it was up $322 per spread here. So on the 7th, it was traded at 140.29. So this trade went from $74 was the original cost. Now it's up to trading at $396. So this was up $322 per spread, or 435% return on your risk of 74 versus if you did the shares 3.66. So you're getting that big advantage of your time decay, volatility collapse, low defined risk, and high return on capital. So those are a couple of different examples there of the beauty of the butterfly. And now here's an example of a long condor, a long call condor on Valero, the refiner. Okay, so this is another alert trade set up. And so with this, the condor is going to give you a much wider profit zone than the butterfly. Going to be, again, structured for defined risk, great for hedging, used for your directional swing trades, a wider profit zone you can see here. Great for trading high volatility markets because we're getting our risk down because the spread. Trade duration 1 to 3 weeks. Also positive data, no time decay. Return on capital on these types of trades, 2 to 1 or 4 to 1 are usually common for these types of trades. So here's one that we set up. This was on the 17th of August. Again, it was alert trade. These are all alert trades. So this was sent out. Said new Valero long trading at around 116.94. Daily volatility squeeze. That's a pattern we look for, a volatility squeeze. So by the 26, 117, 121 call at around $1.95. Okay, so we can leg into these. So this one we actually legged into. And then it said on an upside breakout, we'll adjust to a long call condor. So then we would be long the 117 call, short the 121, and short a credit spread against if we did that. So we did do the adjustment right here on the next day, on the 18th, and then profit on the 26th. So this is what that trade will look like, or what it looked like going out. Let me get rid of this. So we set this trade up. This is a shorter duration trade. We wanted to, take advantage of a quick move here. So we set this up versus doing a longer term trade. So it was trading right here. So went long on the vertical called debit spread, and then we adjusted it to the condor. So that we had profit take here and here and here. Okay, so we had multiple different profit zones or places to take profit. And here's where it went out. Looking at the profile here, you can see again on this trade, again looking at the risk first, $107 max risk on the spread. Okay, so 107. So you're long the 117, 121 call, short the 126, 130. Max risk $107. Profit would be the difference between it. So $293 potential profit here would be a 274% return, or risking $1 to make $2.75. So that's the structure there of the condor. And here's where it was going out. This was on the 25th. So we had multiple profit take times to do it. So on the 25th, the spread was trading at 333. So we set the spread up at $1.07. Now it's 333. So profit on the 25th was $226 or 211% return. Okay. So, but then it gets even better. The next day, it went out between our short strikes of the spread. So this was a max profit trade. So a lot of times we'll take partial profit, leave some for the end, and see if we can hit the home run. So then on the 27th, day of expiration, it was trading at the perfect location right between our spreads. And so it's between the short strike of both spreads right here. So that was the max profit of 293. So the spread was 107 to 400, and that's your 293 or 274% return on that capital at risk on the long condor. Now here's an example of a put income calendar. Okay, so this is an income calendar trade using puts for a directional short trade. This was on the Russell 2000. So again, this is going to give you a defined risk trade. You're selling time and volatility. Directional target trade, great for income, getting paid while you wait. Trade duration on these typically would be either, can be 1 month out to 1 week out to a month. So these are longer term type trade setups. Again, positive theta, no time decay. Question, why would the condor be used rather than the fly? Because it gives us a wider profit zone. Okay, if you look again, if you did a butterfly, let's just see, if you did a butterfly, you're what I call threading the needle. Butterflies are great, but you've got a tighter window to really get your big profit. You need, you're threading a needle. Versus if you have the condor, you can widen out that spread, right, to have a bigger profit zone. So that's the kind of the beauty or the trade-off. Now the butterfly, again, is going to always give you the highest return on your risk, but you're going to have, like I said, a little bit tighter window to get that max profit versus a condor. So here's an example that we did on the Russell 2000. This was again, these are all alert trades. So new IWM short trade at 119.19. So this was a pattern. Okay, so a pattern, what we call a cycle high retracement reversal. So this was the perfect option strategy for this pattern. All right, so it was a reversing at the 200-day moving average. So this was buying a calendar. So we were going out to the 29 August long and the 19 August short, 195 put calendar at around $1.20. So this was trading at 199.19 and then took it off on the 19th. It was trading up to 194.65. So let's take a look. So got into the trade here. So this is what I call my extreme range bands. So this is like 3 ATR. This market at that point in time was super stretched to the upside. All right, so this was back when we had that big, huge short covering rally back up. And so you can see it got out here over that 3 ATR. So we shorted it right there on this reversal signal right there. Okay, this is a cycle reversal. This is an indicator that I use. So it was a perfect trade setup using the calendar. We kept it really cheap, low risk, and we're targeting just right here to 195. That was going to be our target. So right here. So we got that target hit. So we went ahead and took the profit. Now you can adjust these as well. So this was the trade, how it ended up. So here was the on the 16th it was set up. This trade at 199.19. Then on the 19th it was trading right here at 194.65. So it was trading really close to the upside, not perfect, but very close. So this went from 120 on the spread to 322. All right, so that's your $122 per spread profit on your risk of 120, so 102% return. Now this gives you high positive theta, and we can then adjust if we need to calendar or a lot of other different things that we can do with the spread. Now here's the next one, which is kind of a one that we do a lot of because we get that additional bigger profit zone because of the diagonal part of the spread. So this is the calendar diagonal. So this one was going to be using a put again on QQQ. So this was a short trade. Okay. Again, defined risk trade, defined as a debit paid. We're selling time and volatility. Great for directional target trades. We're getting income and getting paid while we wait if we need to wait longer for the direction to kick in. But a big positive plus here is you get a greater profit than you would with the income counter because of the diagonal part of the spread. So trade duration 1 week to a month are typical timeframes that we'll look at. Again, positive theta. So this is one we did. This was just, this one really nailed it. This was the super big home run. So this was a QQQ long put calendar set up on the 7th of October. QQQ was trading at 274.75. Did a couple adjustments and adjusted this down to a very small amount of capital at risk. So you can see here, new QQQ short trade at 274.75, breaking down after today's non-farm payroll number came out, looking for a retest of the lows. So buy a diagonal 19 October, 10 October, 274, 269, put calendar diagonal at around 540. So that was the initial setup, and then we adjusted it one time to really low cost, which you'll see, and then had a huge profit on this one. So, with spreads, you chip away, singles, doubles, and occasionally you get these massive home runs. So we did the adjustment here, set up on the 7th, then adjusted it to a put calendar diagonal, but rolled down the long and short strikes, okay? So then took profit on the 13th when it's trading at 256. So what we did with this adjustment, we were able to roll this down. We had amortized down the cost, and we rolled the spread down. We had a spread cost now of $50. That's it, max risk. So we started out with the wider spread that let me back up, 260. Let me show you here. Let me move back up just a second. I'll show you. The original trade we set up, we were long the original trade. We were long 274, 269. Okay, then we adjusted it down, rolled it down, and now we were long the 267, 258, had a huge profit from rolling it down. So that amortized and reduced our cost of the trade down to $50. And then you can see on the 13th right here, this trade was just ripping on the downside. It was trading right there. So it's trading at 256.68. So the spread went from that adjusted 50 cents to now 794. So we were up $734. So this is over 1,000% return, 1,468. So that's, what you can do with these spreads that are just, just have so many great benefits to the trade. So that's look there. So, today was just a start. As you may know, options are my favorite trade vehicle for any and all my market trades and market conditions. But today I was, able to scratch the surface for you. Now, let's discuss, the next steps if you can take now to start mastering the fantastic trading benefits of options. So if you'd like to join us, and I hope you do, I'm going to be doing an option workshop, just a really in-depth, intense kind of boot camp workshop next Saturday, starting next Saturday. So the Ultimate Option Guide workshop, when and how to use which strategy for the best results. So this will be starting next Saturday, the 29th of October, 11 to 2, and then we'll have a session on Monday, 5 to 7, and then we'll have another session on Tuesday, and then a Q&A. So let me give you the links here if you'd like to join us. Hopefully you will. I've got two different packages. One is with just the course itself with some really great bonuses, and then the other is if you'd like the alert service with it as well, which is a big plus guide there. So use that link there. It should be, click on that, make sure that's working. And yeah, that works good. So just click on that, or you can copy and paste. And you can see this will be $247 plus. You're going to get all of the bonuses, all that good stuff from that link there. So here's everything you're going to get. Yeah, cycle high retracement reversal. Yeah, I can clarify that. Sure. So with this package here, you're going to get everything that you're seeing on this page. You're going to get my live 6+ hour option master's guide workshop that we're going to start next Saturday. Then I'm going to give you before the workshop that I did on the options. This one is more focused on the Greek, so I thought I'd throw that in for you. So this is an options master's workshop that's a little bit more kind of focused in on all the different Greeks. So it's a really good one to have for your trading library. So if you look at the website, these are, what's the prices on my website, $497. Then you're going to get my new Fibonacci price target mapping. So this is how we set our profit targets and defense targets. So you'll get that. You'll get my option trading, start trading options today. You'll get this course here. You'll get my membership for 1 month if you do this package. You can start it anytime you want. Hopefully you'll stay with us, and it's $97 a month, or you can do an annual membership. So you'll get that, and you can start. You don't have to start it today. If you want to start it after you take the course, whatever, you can do that. Then I'm going to give you some really two good indicators that I use for a lot of my trades. The first one will be my reversal indicator, and then the other indicator is extreme range band indicator. So you'll get both of those indicators. We'll do a follow-up Q&A. You'll get my option trading tutorial. So this is another option guide with videos. And then you'll get my option strategy guide, 15 other option strategies that you can use. So really great package, $247 is your price on that. So really great price, great bonuses. And then if you'd like this with the alert service, here's the link for that. So with this one, you're going to get, let me give you the link. This is everything in package one, but with the alerts, okay? And I'll go through that. Now, we've been having great success with the alert service, knock on wood. We've got really great high winning percentage on these trades. Last week we had all winners, so it was a good week. Most weeks are really decent. So if you've been looking for more help and guidance in your trading, then this alert package is just for you. So with this one, you're going to get my alert service. I have 4 different alerts that I send out. You're going to get all 4 of these for 3 months, but then you're going to get the trading club for an additional month. So you'll have access to the trading club for 4 months. So you'll have everything in package one, and this $297, that should be $247, but then the alerts. So what you're going to get here is you're going to get any alerts that I send out for butterfly long condors, calendar diagonals. We do a lot of earning trade setups. These are typically double calendars, and then breakouts. Okay, so 4 different alerts that may be sent out. We get all 4 for 3 months, and then a third extra month just for the trading club. So if you want to do this one, it's going to be $647, and there is a 2-pay available. So let me make sure this is working fine for you. So yeah, looks good. So you'll get, everything in package one, but you're going to get the alerts here for 3 months plus the trading club for 4. And if you want to do 2Pay, that's available as well. So that's everything for you on that. So any questions on that, let me know. So with this, you have access to all alerts for 3 months, typically 10 or 15 stocks a month, or ETFs. These are all stocks or ETFs. So I'll send out alerts for, selective calendars or calendar diagonals, selective butterfly or long condors, specific earnings trade, breakout and reversal trades. You get a trade guide for each trade that's set up. You'll do a trade setup. I'll do a trade setup video review. That night of the trade, trades are listed and archived. Then we do a weekly trading Q&A, which is live and recorded. So usually every Tuesday. So you'll receive this for 4 months as your trading club. Do a video newsletter every day after the close. You'll get that for 4 months. Virtual trading room is open every day during the morning. You'll have that access for 4 months, and discounts on any courses or software on my website for the next 4 months. Yeah, these can be used. No, these are not day trades. I mean, you can day trade, but these are, spread alerts. You should be able to use these in your IRA. So here's a summary of the trades. We've had great success, touch wood, since starting this back in May of 2018. So I've started with the breakout trades, but then added butterflies, calendars, earnings, etc. So, but through the 20th, we've had a total of 523 trades closed. Really high winning percentage, 404 winners, 19 break-evens, 100 losers, 81% win rate. Okay, so this is a super high win rate. So Power Cycle Trade Alert Guide. Now these are unaudited, but these are a summary. But again, full disclaimer, these are unaudited results. So here is the calendar diagonal alert service. So this one has been, we do a lot of these just because the different variations and the dynamic of when to use it. So this started back in June of 2019. We've had 161 trades closed, 127 winners, 5 break even, 29 loser, 82%. Again, unaudited, high winning percentage. That's where, I really strive for high winning kind of results. And some are just, like I said, singles and doubles, but then you get the big one like that QQQ, which was over 1,000% return. So it keeps you in the game, And then here's the summary for the butterfly long condor alerts. So started this back in May 2019. So we've had 106 closed out, 81 winners, 5 break even, 20 losers, high winning percentage there. Now these are typically lower risk trades because they're butterflies. So it can be on average of $40 per spread to $100, something like that. But then you get the potential for big, risk reward. You can see that possible for 2, 4, 5 to 1, 10 to 1. And then the first service that I started was back here, the breakout reversals. Started this back in May of 2018, right here. And we've had 156 closed, 115 trades are winners, 6 break even, 35 losers. So most all the trades we've been doing lately are going to be either the butterfly, long condor, or the calendar diagonals. And then we do earnings trades as well when we get the specific select setups for those. So with the earnings trades, we've been using what we call a double calendar. These have been really high winning percentage trades since using it. So we started this back in 2019. We've had 100 closed out, 81 winners, 3 break even, 16 losers, 84% win rate. Again, all unaudited results there, but that's kind of an overview flavor of what these different alerts can do. Yeah, so the earning trades are, we've been 84% winning trades. So here's an overview of the course. So we'll start next Saturday, the 29th. So it'll be live and recorded. So we're going to go, I always like to start with the Greeks, how they're used to give yourself trading advantage, the Greeks and the proper, advantages of that. again, how option pricing works, and it's used for selecting your best strategies to use. More detail about standard deviation for your probability trade analysis and price forecasting. So you're going to know in great detail how to use this, explain in layman terms. So it's going to make it easier for you to understand and use. So also then how to use your option delta and trade probabilities, how to use those, how and when to take advantage of volatility and volatility skew, what that is and how that's used. You'll learn all that. You're going to learn a super amount of things in this option course. And then we'll get to the option strategy guide. So this is going to be the process that I use for selecting which strategy to use and when. Okay, so it's going to be based on this process of what's the market cycle. So we'll go through how to quantify that. What's your market environment, the range of uncertainty, and then the selective chart patterns. So these are conditions that I look for, to help set up, okay, what option strategy are we going to use, and then when to use it. So then we'll go into the best option selling strategies, what they are and how to use them. The best option buying strategies, what those are, how to use those. The option butterfly, the great trading advantages for high volatility markets, selling time and volatility, and hedging. This strategy provides returns of 100 to 1,000% or greater. Great capital at risk, amazing strategy. So we'll spend a lot of time on the butterfly, when to use, how to use, and when to set up. And then we're going to go through the long option condor and low defying capital at risk strategy. So when we're hedging, usually the first step is with the long condor spread. So that'll be explained in great detail, the hedging aspects of using butterfly or condor, and then how, why, and when to use the long condor in your directional trades. And then we're going to go through the course, the calendar spread. So this is a timing income spread, when and how to use it. The calendar diagonal, medium to longer term directional timing income strategy, and how that calendar diagonal works to create a market neutral and directional trade with defined low risk for income and potential big profits from a market directional move. So how this strategy works based on capturing time decay without completely sacrificing directional speculation, and how to structure to profit from the difference in implied volatility between your short and long dated. So these are my go-to strategies for every condition of the market you can be in. And so the course is designed to teach you what strategy to use, when, and then how to use it. Okay, so going through these, we're going to go through, explain in depth buying and selling options, the vertical debit spread, usually calls or puts, the butterflies, long condors, calendar diagonal. So these are the strategies that I tend to always go to based on conditions in the market, cycles, etc. How, why, and when to hedge. Okay, so the progressions of hedging. So we're going to use these spreads for hedging. So we'll go through a great series in the course on hedging and how to use your butterfly condor hedge, how to adjust trades to a free trade. So this is something that we're constantly looking for, a way to adjust trades to a free trade or reduce risk or reduce theta. So step-by-step guide, we'll go through how that's done. Assignment risk, expiration risk, auto exercise, and a trading library. So very extensive course. And here's from Dennis said, just finished the options master's course, loved it. Hedging on demand is the game changer, allows one to enter trades with confidence. Already 2 of my probability trades, which were heading to my short strikes, were converted to butterflies, which I exited at a higher profit than the original trade forecast. I slept much better and the funds were reinvested. Compound interest is a little magic, seldom talked about. So that's a nice feedback there. Here's the link again, George, for the alert service. And here it is for, if you just want the package 1. Let me put those back in here and take more questions here. So here's package 1. And again, these courses are yours forever. And you can start the alert service or the trading club whenever you want. So let's go through the enrollment bonuses. So powercycletrading.com/guide. So first, bonus 1, you're going to get my on-demand recorded options master's course that I did. And this course, though, the difference in this course is, the reason I wanted to give this course out is that It's more geared and focused on greater focus on the Greeks, okay, and kind of options in general. But it's super great course, so you're going to get that on demand. So how to use all the different option spreads, but a lot bigger focus on the Greeks, gamma, delta, theta, etc. Okay. Then bonus 2, you're going to get my new price target mapping course, Fibonacci and more. So you're going to get that. This is what I use process for targeting prices for profit or targets for defense. So it's a combination of using Fibonacci, moving averages, price, what I call price action support resistance, standard deviation forecasting, and option activity. So this course will take you through this process for setting up your targets for profit or targets for defense triggers, things like that. So really great course here based, foundation of it's based on Fibonacci. So you get that as a bonus. And I just did that, completed that was in October. So very, very fresh new course there. Yeah, John, if you do, here you go, John. So yeah, you can do that, John. Here you go. All right, so then you're going to get my Get Started Trading Options, bonus 3. So this is a really nice kind of beginner's option course to add to your library, get you started trading options. Comes with PowerPoint, training manual, videos. So comprehensive, easy to understand option trading, perfect introductory course for you if you're starting out. So it goes through the benefits of options versus stocks, what you need to know before trading options, must know option basics, mastering puts versus calls, strategy covered calls and a covered call with protected puts. So 2 really great strategies and kind of combined in this course. You'll get that. And then bonus 4, you'll get membership to my Power Cycle Trading Club. If you do package 1, you get this for 1 month. If you do package 2, you're going to have this for 4 months. And you can start it whenever you want. So you can also pause and keep your time, alive if you want to do that. So with this, you get access to my virtual trading room, open every day, 9:30 to 10:30. So Monday through Friday. So I'm in there, whatever trades we're looking at to do, or if you need help on a specific trade, I'm there to help you on that. So this also provides daily video newsletter updates after the close. All trades are archived. We do a live weekly Q&A, typically every Tuesday, live and recorded. Great Traders Educational Vault, good trading educational material there, discounts on all courses and software on the site of 60% off. So just wanted to tell you, Larry, my option knowledge has leaped exponentially since joining your trading room. Reading books is fine, but seeing the actual option trade setup makes a huge difference. Thanks, Jay. That's so true. So you get that, and then here are the 2 indicators you're going to get. You're going to get my cycle reversal indicator. All right, this is based on what we call, percentage range bound momentum indicator that I designed this for. So when we get a reversal up or down, this is kind of the first indicator that we use. It's got a lower, upper, lower study. So this is available. You'll have it for Thinkorswim, TradeStation, or TradingView. Thanks, Michael. So this is such a great indicator for all the trade setups typically that we do. So you can see here's the cycle reversal indicator. This is just an illustration on Thinkorswim. You can see the reversal right there. See the arrow? So this is cycle reversal on the daily time frame. And here it is right there. Again, see the reversal? So that's what it looks like. That's TradingView, and I've got this available for Thinkorswim, TradingView. Hold on. Okay, so you'll get that. Yeah, this would be a cycle low. This would be like a cycle low reversal retracement. So we'll go through all the patterns in the course. And here's your cycle reversal indicator. This is TradingView, their platform. So you can see it right here. So you can see the reversal arrow and signal. This is just one indicator that I like to use. See that right there? Here's another reversal right here. Here's another reversal right there. Okay. So you'll get that indicator. And then this is a super great indicator when we get markets that are really getting stretched, really extremes, either up or down. This is an indicator design called extreme range band indicator. So it basically identifies price extremes when price is either too extended from its mean or up or down. So it's an alert signal for buying or selling exhaustion. So this is typically what we use when we get these big retracements. We use this indicator. So this becomes the first signal that a security is starting to reverse, very accurate in signaling in advance potential swing trades or long-term market reversals. So this is available Thinkorswim, TradeStation, eSignal, NinjaTrader. And this is based on 2 and 3 ATR. So these extreme range band lines, like this white one would be 3 ATR, the blue one's 2 ATR. So when we get extreme and we get then that linked with a reversal indicator, it's such a super great forward-looking indicator. So here you can see very extreme. Then we get the reversal here. So that's why I give you both indicators, and we'll go through how to use those. So 7, we're going to do a follow-up Q&A. So typically the day after the course. So this will be live or recorded. And then don't forget, you get those virtual trading room access for 30 days if you do package 1 or for 4 months. So that's a great way for you to come in and get more trading support. Then you're going to get some more help with options. You're going to get my option trading tutorial. So this is another 60-page option guide with videos that covers the foundation of your option trading, the Greeks and probabilities. So just another great course to add to your option trading library. So it's going to go through more detail of the Greeks, option pricing, market maker secret, standard deviation, option delta, and probabilities. So you're going to be covered for options. So I remember one of my members, Jim Porter, said, man, it was like getting your PhD in option trading. And then last but not least, I'm going to give you 15 option strategy guides. So this goes through and shows you, okay, what is a back ratio spread? So trade construction, when to use it, what's a long arm butterfly, what's a long strangle or short strangle. So just more option information for you right there. And here's bonus 7. Go back to bonus 7. Yeah, so bonus 7, we'll do a follow-up Q&A live and recorded. So we'll do this usually the day after the course, and then you also remember you get access to the virtual trading room. So that's bonus 7. And then this option guide as well. So here's a little bit more summary of the alert service. And again, you're going to get 3 months of the alert service, all 4 of my alerts that I send out, 4 months of the trading club, package 1, which is $247, it should be, and all indicators and bonuses. So this is $647 with the 2-pay if you like it. So you'll get the alert services for 3 months, and you can start and stop when you want. So if you go on vacation or need a pause, we'll pause it for you. Plus you'll get the trading club for 4 months, 10 to 15 stocks or ETFs. So selective earnings, trades that are sent out, selective breakout and reversal, selective calendar and diagonals, selective butterfly and long condors. So from Waleed, one of my members in Kuwait, he said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing that I would like every person on this webinar to know is when I get a trade alert from Larry, I do it blindly, as time has shown me that this man is accurate in his recommendations. Thanks for the great service, Waleed. And this was from Scott. This was a really nice compliment. He said, I've been trading with Larry for 3 months. He's been a lot longer than that now. But after 20 years of trading, I found Larry to be the best trainer coach in the business. I joined for a year and paid for my annual fee within 2 weeks, and that was doing small trial trades. It'll be the best investment that you'll ever make. Go with the elite package, great group of traders as well. So with any alert sent out, you can do your own thing. A lot of members do their own thing, but I'll always send out a suggested option trade for it. It'll give you the entry level, price target levels based on my price target mapping, what option series to use, stop loss levels and guidelines, any adjustments. I'm sending out constant updates on trades during the day. Trades will be listed and archived and reviewed. Trade setup review video of the trade, video newsletter every day after the close. live weekly Q&As, access to the trading room. So you'll get this as an alert member for 4 months. And you can see the alerts, 81% overall there. Let me show you what use a service called Telegram. And here's what it looks like. This goes out within seconds of me putting out the alert. So we had, here's just kind of what it looks like. We had on Friday had a couple of here. You can see these were all different alerts sent out on Friday, the 21st. QQU short trade around 269 if long, blah, 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 take some profit. Close out any balance. Here's XHB. We had a short trade on XHB. Take some profit. It's a profit take. We have a long trade on XLE. I'll show you that. Take some profit, etc. So this is what you'll use to get your alerts. And then let's take a look. These are a calendar. I showed you those earlier. Here's one that we currently still have on. This is a call counter diagonal on XLE. So you can see this trade set up here. If I pull it up, we've got what we did was back last week on, I forgot exactly which day. Let's see, we did this one on, I think it was Wednesday. So we went out and bought the 18 November 83 call, sold against it the 28 October 87. Spread cost 348. This went out 433, so it's up, going out $84. Now, if we get this to next Friday, the 28th at 87, this trade will be up $209. So that's kind of one trade that we currently have open. And here is the chart of it right now. Here's XLE. You can see this trade was a beautiful trade setup that we did. And looking for, targets here, we had hit our target close to 87 as our first target, potential to go to 89. So that's the trade setup that we currently have on there. And then I'll show you another one that we currently have on a long condor on Adobe. So this was that put calendar diagonal. This one just killed it. So this was up over $734, over 1,400% return there. Here was an IYR, is a put calendar diagonal we did. We set this up on the 28th. It was trading at 82.22, took it off the 13th and the 14th, trading at 77.60. So this was a put calendar diagonal. So new IWR short trading around 82.22 based on continued mortgage rates and 10-year Treasury note moving higher, looking for a continued move lower to power cycle trading target 179 and target 277. By the calendar, the 21 October, 30 September, 79 calendar at around $1.30. And then we did an adjustment and ended up beautiful trade, just a trend down. So we do a lot of different counter diagonals on ETFs. We've been doing a lot of those. Took this one off right there. And so you can see it went from $69 when we set this up. We did an adjustment. And then we were into the 79, 78. We adjusted this to put counter diagonal. You see that started out as a calendar and then out at 172, so up $103, 149% return there. Butterflies, I showed you this earlier. Here was the alert trade on Apple. So that butterfly was up 322%, or let's see, it was up 435% return. And then we did the other one, the SPY short right there, which was up $240 or 208% return. So that's everything. Here's one more that I'll show you since we've got it. This is the long call condor on Adobe, and we've got that open and super low risk trade. We did one adjustment on it, and so these are what you're going to learn in the course, the strategies of when to use it. So this is what we call a volatility squeeze, the pattern. So we set this up for a breakout and targeting up to about 321, 322. So here's the currently where it is right now. If I can pull this up, we've got this current trade set up where we are now, after the adjustment, we are now long the 28 October 307.5, 310 call debit spread $1.02. and then we sold against it to make this structure here, this condor. We sold against it the 28 October 322.5, 325. So you can see the structure of the spread is this call debit spread here, and then we widen out the credit spread here. Okay, so this has potential to make this. We've got a total risk here of 102 minus 27. So this has potential to make, put in the spread here real quick. So we're currently the spread at 75 bucks. That's the max risk, $75. So 75 risk, potential return 175. So that's a current trade that we have on there. So that's pretty much everything. Any questions or anything else? This is what you'll get. Here's your package one. Be happy to take any other trades or anything you'd like to look at. I'm game. So here's your link for course package one. And again, this is yours forever. And even if you don't stay on as member, you'll always have, get your login password and get into it. Yes, if you're stuck on a trade, you can get help and coaching from the trading room. So yeah, just that's why I set the trading room up. You'll get help on any trades that you have on that we're not doing. If you need help, I'm there to help. Cycle high reversal. Yeah, here's a cycle high reversal. So here's just extreme range bands. For example, you can see, let's see here, we've got, I'll put it back on that Russell trade. Well, here's one, here's a good example. This is IWM Russell. So here you can see just this extreme range band. You see how it's stretched? It's at the 3 ATR right here. Okay. And then we had the reversal here. So this was a great little cycle reversal for trend trade back up. All right. So that's an example there. That's a cycle low. This is cycle low. Now here would be a cycle high retracement. Well, let me see if I can find another example here of a cycle high retracement for you. We haven't had too many up moves lately, so it's hard to find cycle high retracements. Let me see here. Well, we're just not in the market has just been this massive downtrend. So here I'm trying to find a cycle high retracement reversal. Here's one right here. Just you see how this is Apple retraced up here to these moving averages, and then you can see the reversal here. And that's also, we used another indicator, moving average cross indicator. Yeah, the indicators work on any time frame. Yeah, you just put it to the time frame you're looking to use. And I typically like to use the daily 4-hour hourly, so we can put it on any time frame. So we can put it on 4-hour. We can put it on hourly. So this is with the extreme range bands. Here it is just with the reversal indicator itself. So you can see here, this was on Apple. See the cycle reversal right here? See that? This is on a daily. See that? Here. here. And you can put it, if you want it lower time frames, you can do that. You can put it down to, like I said, 1 hour, whatever time frame you need. Okay, well, any other questions? That's pretty much it. Yellow arrows, these are momentum indicators. So based on momentum up or down, those are arrows that are signaling that. Let me show you the other chart package here. See the yellow arrows here, that's based on momentum cycle 1 going lower. You can see down here negative. And the red indicators linked to cycle 2, which are both negative. So when they're down, arrows are pointing down. When they're up, arrows are pointing up. Here's like a cycle 1 positive there. See that cycle 1? So these indicators are available to you as well. There is if you want the upsell after you buy today, you can get the rest of these indicators for $195. And they're good for Thinkorswim, TradeStation, eSignal, Ninja, TradingView. And they're available for wealth charts as well. Yeah, they totally work on wealth charts. Yeah, got them on wealth charts. Let me show you real quick. If I can find it real quick for you. So here they are, wealth charts. So here are my custom indicators for wealth charts. Whatever you want to put in there. So they are available for wealth charts too. So for TradingView as well. I like to use Thinkorswim, but I have all the indicators for Thinkorswim, TradeStation, NinjaTrader, TradingView, and wealth charts. Oh, I'm glad you signed up, Elise. Yeah. Yeah, so when I'm teaching, I use primarily Thinkorswim. No, you can use whatever brokerage account you want. There's no, I don't suggest or whatever. I like Thinkorswim, but there's tastytrade. There's just some really great services. Okay, any other questions? So that's pretty much everything. Hope I was able to get your questions answered, give you a good highlight of the potential advantages that you get from these different spreads. And the course, though, will teach you in much greater detail how, when, and why to be using the specific strategy for the option environment or the trading environment you're in. So it's not, the environment you're trading is a big component of which strategy to use, and that's going to be based on a number of different conditions. Chart patterns, cycle, are we up, down, sideways, extreme of the market, is it high extreme, low extreme, things like that. So we'll go through all those conditions for selecting the right trade. So there's everything there for you. Yeah, thank you very much there, William. Appreciate your input. Appreciate that a lot. That makes my day. So thank you so much. Thank you so much. Annual fee for the alert service. I'm doing it now quarterly. Okay. So if you look at the alert service, it comes out to, if you take the price of the alert service is $647. If you look at that just based on its own, you know, back out the course, $247. You're looking at you're looking at 100 basically you're looking at $133 a month for the alert service, plus you're getting the course. So it's a pretty good deal. I don't know anybody else that's I don't know what other alert services are out there, but if you look at this $647, this includes the course, $247. Now if you back that out, then you see the alert service, you're paying for $400 for 3 months, but then you're getting plus 4 months of the trading club. So basically you're paying $133 per month. For that $133, you're getting that for 3 months. You're getting all the alerts, all 4 different possible alerts, trade guides, setup videos, trades listed. Then you get for four months access to my trading Q&As every week, video newsletter after the close every day for the next 4 months, trading room, and discounts on all courses and software. So it's you know, I think it's a great deal. And again, we've had great success, touch wood. So this past week we had profit. We had QQQ, put counter diagonal. I took profit on that. We had XHB, put counter diagonal, took profit on that. Had what else? We had XLE, took some profit on that. Probably forgetting something there, but we had some really good trade setups. All right, so that's everything. I really appreciate everybody being here, and any other questions, let me know, or we'll call it a day.